Hello and welcome to Success and More Interesting Stuff, brought to you by Livewire Markets. I'm Matthew Kidman. And today we're celebrating our 50th show. It was 5 years ago that we sat down with Grant Hackett for our first ever show. It was in a COVID summer where we were looking to fill in a few hours. Not long afterwards, we went to a monthly show, and now we're approaching close to 250,000 downloads. But for the 50th show, we're going to mix it up a bit. It's going to be a bit different today. We've got two guests that have been on the show before and an industry legend to talk about some of the crucial issues that is in the market right now. So with us today, we have Chris Judd, who was episode 11 back in January 2022. At the time, Chris was managing his own money, trying to earn out a living from that. Since then, though, he took the bold step to set up his own funds management business, Charuti, which concentrates on macro themes. And so far, so good. Very good. Our second guest, Junbei Liu, was episode 12 in January 2022. At the time, Junbei was working for an established funds management group, Tribeca, but like Chris, she's branched out on her own and she's got her own funds management business now, 10Cap, and like Chris, so far, so good. Our final guest is an industry legend, Shane Oliver. Shane has been around for a long time. He's got a wealth of experience. He's the head of strategy and chief economist at the AMP, and he joined the AMP, wait for it, 41 years ago. So welcome everyone. We're going to cut through 4 topics today. The burning issues that are taking the market at the moment as we see them, and the year ahead, of course. The first one we'll talk about is store of wealth. Now, I've divided that up. There's precious metals, and of course, there's cryptocurrencies, of which there's a number of products. I'll start with you, Chris. I remember when you came on our show a few years ago, you talked about currencies and maybe we need to find other things to invest in because currencies were under pressure and the devaluation. Gold and silver had a really good year. So silver, ironically, got the gold medal this year. It was up 100%. Gold got the silver medal. It was up 60%. Bitcoin, the head stock for cryptos, was flat, got the bronze medal, and Ethereum was down 15%, so it was out of the metals. So pretty good year, especially for the precious metals, not so much for crypto. Chris, what's driving, do you think, this run in precious metals, and especially gold, which is the big element in that area?
Oh, look, I think there was a huge shift in precious metal market in 2022 when Russia invaded Ukraine and $300 billion of their FX reserves got sanctioned by the United States and its allies. We saw a very strong correlation between real yields and gold break down at that moment. And there's been sort of a constant bid for gold, particularly through central bank buying ever since. So, we're sympathetic to the view that US Treasuries are no longer the world's reserve asset. There is a huge amount of surplus wealth stored in US Treasuries. And if that statement ends up being true, the bid for gold is very much just beginning. And even though silver did outperform gold this year, we still think it's got some catching up to do. If you look at previous cycle highs for gold, around $2,000, gold in this cycle is now more than double that, trading over $4,000 US. Silver in its previous cycle highs of $50 is still only 20% above its previous cycle high. And its industrial applications for silver in electronics and solar and medical equipment are growing strongly. It's an accepted way to store wealth in India. And there's evidence that more Indians are turning to silver as their currency is being debased. So while silver's had a great one, we think there's plenty more room to go in 2026. And in terms of crypto, we'd very much separate Bitcoin and the other tokens. We don't think the other tokens are a store of value. We think they're more of a technology play and a speculation asset. We think the US is trying to make Bitcoin the center of the financial universe. We think China is trying to make gold the center of the financial universe. And it'll be interesting to see how those two play out. Bitcoin in particular through stable coins, which is what most investors use to buy their Bitcoin, has an ability to solve the US's funding crisis and bring a brand new buyer of US government debt that at a time when the Saudis are no longer recycling their surpluses into US government debt, the Russians aren't allowed to, China are less interested, in Japan, if anything, have been sellers of US government debt. So there's now $300 billion of US government debt. owned by stablecoin companies, and we think the US government is very much incentivized to push Bitcoin prices significantly higher in the long term, largely because of what it will do to that stablecoin market.
So it sounds like you're bullish on both. I'll go to Jim Bay now. So you might have a different view on all those comments to Chris, but gold's become an important part in particular in any portfolio in Australia. So for someone who's running a portfolio of size, how do you handle it, and how do you see precious metals at the moment?
Yeah, look, precious metals, I think they are doing what they're supposed to do. Think about the old playbook for the gold, right? So it's really about hedging against geopolitical uncertainty. We had the geo-conflict and others. Hedging against inflation, and we had a bit of inflation scare and others, although it's coming off and so on. And then all of that together just means it's a pretty good environment for gold. Like you said, every portfolio here in Australia, we will have some gold, regardless of what happens, because it's good diversification from the rest of the world. The way I see it, I think the gold is well supported, particularly as central banks and governments out there adding to their reserve in terms of gold. And I think it's like the portfolios, like institutional investor, it will in the future always feature a very, very important part of the portfolio of the currency hedge. Now, I think it's very interesting. We think the gold is going to hang in there for pretty well, and I think the support is pretty good. The digital currency you mentioned earlier, I want to add to it too. I think that's it's almost hedging against similar sort of thing, but it is more a higher beta version of it. Those cryptocurrency, particularly Bitcoin, really, it's been acting as a risk asset. However, it's hedging against the same printing of money, lots of printing of money, uncertainties, and diversification from the money it is. So I actually think for cryptocurrency, the Bitcoin in particular, does have a very interesting future in the portfolio, but clearly it's still very early stage. You still have the regulations to come through, but that's a very, very exciting part of the market we're all watching.
And just let's go back to gold. How do you play it in the portfolio? Do you buy gold direct, or you've got to buy the stocks? And do the stocks represent good value given where the gold price is at the moment?
That's a really, really good question. So through our portfolio, we do buy the equities, the listed equities, the stocks first instead of the gold itself. Now, what's interesting about the gold stock is that most of them don't really reflect the gold prices, especially if the gold prices rally significantly. If we look across a whole range of stocks, the large caps generally reflect lower prices simply because they have longer dated contracts and then they can't realize those spot prices until later. So they actually look quite cheap based on what the earnings upgrade might look like. And some of the smaller names that they may start running with the gold because they can realize the spot price and then they don't have long dated contracts. So the way we play is that we always have a large cap names in the portfolio, and then we have a couple of upcoming smaller cap. One is to capitalize the current high prices. Two is actually benefiting from the growth in their production. The larger ones generally a little bit more stable and less growth.
Right. Now, Shane, you've been through a few cycles. We mentioned that in the introduction that you've been around for a while. Do you agree with the investors here as an economist that that's why gold has performed and given the environment, it's got the potential to continue to perform on the upside?
Pretty much. I'll add a few things to it. One is, I think the gold, I think Chris mentioned, is in the early days of an upswing. If you look at it relative to equities, if you look at relative to past bubbles, you can do all sorts of debates as to what a bubble was, but say the tech boom, Asia, Japan, GFC, you compare it to those events, what we've seen in gold is relatively minor so far. It looks like a bit of a non-event. Secondly, I think the geopolitical issues have intensified globally. That creates a degree of uncertainty. Demand for gold flows out of that. The world has become a bit more inflation prone. And of course, in the US, there's concern that the Fed might become politicized or lose some of its independence. Become more so under Trump. And that in turn could have the effect of, use that silly word, debasing, buzzword of the year, debasing the US dollar over time. The US dollar has been in a downtrend anyway. And then finally, you've got the excessive levels of public debt in the US, in Europe, parts of Europe, France, Germany, Japan, and so on, all of which creates some incentive to debase currencies by some form of inflation. So even if you don't believe the Fed's going to do that inflation in the US is going to get out of control, I don't think it will. There'll still be demand for a hedge against that risk. and that therefore suggests to me that gold has more upside from here. I mean, it obviously got overbought going into October. It went too far. People queued up outside the office in Martin Place. I mean, that's
the length of the queue tells you something.
Yeah, it tells us something, and it had to have a correction, and that's what we've had. I don't know whether it's bottomed or not, but I reckon there's still more upside to go as we go through next year, and therefore there is a case to consider it in your portfolio.
Yeah, I'm a little bit worried now because there's a bit of consensus around the room. But
That's
anyway,
always
we'll
a
go
concern,
with that.
yeah.
Chris, coming back to you, what happened with the cryptos this year? Bitcoin, Trump came in, was obviously very supportive. Everyone was waiting for the regulation or lack of regulation and making it, an asset class rather than a fringe kind of punting asset that only a few were in. Now it's become mainstream. But it didn't go anywhere. It was flat for the year. What do you think happened?
Yes, I mean, I wouldn't mind clarifying. We're not bullish on Bitcoin near term. We think Bitcoin, since it was created, has had a cycle where it's been the best performing asset class out of all asset classes 3 years in a row. And then in the fourth year, it's been the worst performing asset class out of all asset classes. And that 4 year where it's scheduled to be the worst performing asset class is in 2026. So on a near-term basis, we'd be very cautious on Bitcoin until that, and that correlation won't last forever, but until it breaks, we'd very much respect it. The price action this year was interesting in a sense of the Bitcoin bulls got everything they'd ever dreamed of. They got institutional adoption. BlackRock and co created ETFs that were the most successful ETFs that have ever existed in terms of amount invested in them. And the price has been bullish, but if you had have told someone all these things would happen, and the price would be sitting at, I think it's about 90 grand US today, I think people would have expected a little bit more. And sometimes when good news keeps coming and the price action stops acknowledging it, that's sometimes a sign that price is due for a bit of a breather. So near term, that's what we'd expect. But on a longer term time frame, we still think it's a very important asset class.
Yeah, all the buyers are already there getting ready for
That's right.
Yeah.
And with the crypto winter, anyone who looks at Bitcoin would see that 4 year cycle. And so at the back of your mind would be, is 2025 going to be a peak and 2026 another crypto winter with an 80% downswing? Now, there's a good argument to say that as it becomes institutionalised, the size of those downswings will become less, just as the size of the upswing. Deeper
markets.
Yeah, deeper market, people in there and holding it for the long term, despite hodl. They have a lot of traders in Bitcoin don't hodl, so I suspect it may change, but until proven otherwise, almost along the lines of what Chris said, you'd have to say, well, there is some risk of that occurring. And if you look at Bitcoin, it's done fantastically well since 2009. But if you look at it from peak to peak to peak along those 5 year cycles or trough to trough to trough, its rate of gain each time has slowed down. And including this recent rise from, what was the last high, 2021, I think it was?
About $60,000 in 2021, wasn't it? And
yeah.
Double what to get to 1128 this
126,
cycle.
127 or something. But each time the multiple of increase compared to the previous high or the low compared to the previous low has lessened. So it's still going up.
Numbers, huh?
They're all big numbers, massive numbers, but it is settling down, and that's inevitable because it was a startup. It behaved like a startup. Now it's becoming institutionalised. When things get institutionalised, just like stocks in the S&P 500 or the ASX 200, their gain potential slows down.
So just a final one on that, Junbei. How do you play if you're an equities person?
It's quite tricky because even though it trades like risk asset, there's no direct equity person. You can I guess you can buy the ETF relevant and others, but in the Australian market, directly as shares to be directly benefiting from it is difficult. There's only one company that has some more relevance, which is XYZ, that does have trading platform in that
on the Australian market.
That's right, but that's a quasi listing from the US block. That's XYZ here. So I think the challenge is that that business still have the afterpay in there. It's not purely the Bitcoin and also, even though the volatility is very similar because it's similar sort of investors, they lever and then they buy more volatile stocks. But it just benefit, like the actual direct translation is very difficult. Hard to find pure play from Australia.
Yeah. All right. Sticking with you, Junbei. AI, which has got all our attention, and the big US tech funds or firms have allocated or earmarked about $1 trillion to invest in building out the AI infrastructure. And we've even seen it in Australia, the ripple effect, the bigger and bigger data centres that we hear about every day. So just give us some thoughts on it, because everyone's assuming the gold rush in AI is potentially a bubble just because of the amount of capital, and very hard to get a return on that size of capital. You got a view on that?
Yeah, I do. I think it's, well, first of all, I think that this whole AI thematic is, when people think about AI, they just think about the infrastructure. It's actually, there are so many things to come through, aside from just the infrastructure, the enablers, the softwares, the everything else that comes with it. It's also other businesses that actually benefit from it, right? So I actually think, when I think about AI, I actually think the opportunity, the beginning of this super cycle in productivity gain, it's only just getting started. Every business we talk to is now investing in how they can benefit from it, or whether it's opportunity, maybe it's a threat, but how to invest into to get ahead of it. So I think this is quite incredible. Now, the question specific here is about all the investment into the data centers and others. I actually think it's actually very hard to value the, because so much money, how much capital has been piled into the data centers and the like. I'm a little bit skeptical. I'm more on the skeptical side. I think the opportunity near term is great. Everyone wants to. It's a land grab. It's literally physically a land grab to get in there, to get contracts. So it's great for businesses who already have contracts with what they're building. But there are plenty of businesses around the world, like you said, all these capital are going to sites and the data center that doesn't have any contract. And those contracts may come 10 years further down the track. In 10 years, I don't know what's the terminal value of those data center, because technological advancement may change. Maybe by then
they might need to be so big.
Oh, they may not need to be. And
could shrink in
that's
size.
right. Or maybe they have this. What's the holy grail of the holy grail of this space is that you don't need a data center that be so close to the client. You can have one like in the in the desert, and then you don't have any latency in terms of transmission. Maybe it's something like that will happen. I don't know, right? So I actually think if any data center doesn't have contract yet for a lot of those pipeline, I do think it's very hard to value. And because by then there's no terminal value, it becomes a shed. It's very like an industrial shed, and I don't know, is Amazon going to be hiring those places? But
we're at that incredible point where the money's going in, but you're not sure what the outcome is. Chris, like we saw this in the late 90s, the internet came along and there was money everywhere. When the money dried up, things collapsed, and eventually after the apocalypse, a number of big companies came about that dominated the world. Do you think we're going to go through the same bubble with AI? I mean, they're big numbers. We're talking trillions.
Not really. I mean, the difference we think is that those internet stocks, they are just the most beautiful businesses ever created. They've got a fixed cost base that doesn't increase as the business scales. So whilst they were clearly a bubble in the late 90s, the fact that they were just the type of business you dream of as a shareholder or business owner was factually correct. I mean, we think a lot of the AI stocks we look at are sort of analogous to the railway companies of 120 years ago, in that they require a huge amount of capex. There's a huge amount of genuine depreciation on those assets, and they'll create a heap of value for other businesses. We're just not sure that that value is going to reside in the AI companies themselves. We certainly think the electrical engineering groups that are being used to deploy that data center capex have done and will continue to do really well. We think businesses with a huge labour force that they can perhaps reduce and make more productive will potentially do really well. But for us, the AI trade is the US electrical grid. We look at China can produce twice as much electricity as the US. It's no wonder the US has restricted China's access to chips, because if they're on an even playing field, we think China's going to win that AI race easily, such as the amount of power they can generate. So that's one of the things in 2026, we think the US electrical grid upgrade is going to become the most pressing issue in financial markets. And it's both got economic and national security interests for the US. And that's where we're placing our AI bets, because we sort of think DeepSeek largely demonetized the large language models by making their software open source. We think the electrical grid and access to power is where the opportunity lies.
So not a bad place for you to come in, because we were talking about it a bit earlier, that data center building is actually now appearing in the national accounts as meaningful. We saw a big kick up, but it's also putting pressure elsewhere. As Chris just pointed out, you need a lot of power. There's power shortages. It's causing disruption in
water, you
communities.
need a lot of
Water
water.
is another one that's starting to make the headlines. How do you feel? Do you feel that the investment is beneficial, or it's going to cause too many stresses in other areas and there'll be offsets like higher inflation, shortages of resources?
Well, it's too early to tell, basically. Firstly, I mean, is there a CapEx boom like there was in the late 90s? The only thing I would say on that is that the CapEx boom back then went on for 5-7 years, and it got to a much higher level of GDP, say in the US. If you look at information processing equipment, it was at a much higher level of US GDP than it is now. So now it's picked up. It's picked up over the last 15 months in the US, but it's picked up from a very low base. So you'd probably say there could be potentially an over investment in this sort of CapEx, but it's nowhere near the magnitude that we saw in the late 1990s. So there's nowhere near the unwind required that occurred after that period.
Or we haven't got to that stage yet.
No, we haven't got to that stage yet.
At the accelerating
this
rate.
could go on for another 3 or 4 years with the CapEx continuing to build up. Then you get to a point of oversupply, and then all those questions that Junbei's referred to start to become bigger ones. You know, do we need all those data centres? There's a bet here that there's going to be superintelligence or something, and that will require the data centres to process. But what if companies turn off it or find cheaper, simpler ways to do the same thing without the requirement for all these data centres? I mean, out of interest, China seems to have gone down more of a path of using AI to produce snazzy consumer goods. Compared to the US, which is more on business productivity gains. And I've no doubt there'll be a boost of productivity here. But as we saw with the internet, it takes a while for all of this to build up, and it's slower coming than you initially think. So therefore, you're going to go through these phases where the adopters start taking it up, and then they think, well, this is taking a while, it's not really working, and then the demand slows down.
Well, to Chris's point, in that period where there was a bit of an internet winter, before the winners became obvious. We had a bear market for 3 years because of the overinvestment. Yeah. And the winners were enormous winners, but there were a lot of losers.
Yeah.
I wonder if we've got to go through the same path.
I'm sure we will go through the same thing. A lot of the focus now is on the, what do you call, enablers. Yeah, obviously.
Which Chris was referring to.
Yeah, which you're referring to. And then you've got the adopters at the other end. I'd probably put more money on the adopters now, because with the enablers, like look at the Magnificent Seven, to pick on a imperfect group. I don't know why Tesla's in there, but anyway, they've had fantastic returns. And is a question mark as to how much longer that will continue. And I suspect that over time, because this is a very different technology. Back then you had network effects. You put in place Facebook, and then you get it, and then before you know it, we all have to have the same thing. Not that I have Facebook. I do have WhatsApp.
We
though,
missed out, both of us.
But you have this network effect, and your fixed cost is minimal, but you just get more users, and you get huge profits out of that. The AI is going to be a lot more difficult. You don't have the same network effects, and in some cases, it's made it a lot harder to monetize it. But adopters, companies who work out how to use it, will make huge benefits from it. So I'd be focusing more on them as an investor and less on the so-called enablers.
All right, before we move on, quick survey. AI, positive or negative, Chris?
For what?
Overall.
As an investment?
As an investment.
Well, AI to us is power and uranium, so positive, but I'm not buying NVIDIA.
Yeah.
Okay, negative NVIDIA.
Okay, Junbei?
Positive, not yet data center.
Shane?
I'm positive, but I'd go downstream and look for the sectors and companies that will adopt it and benefit from it.
Well, I think that sums it up, because we're all in the middle of this CapEx, boom, but everyone's got to kind of try to work out where the best place to play it is.
But the key point from my point of perspective is, are we in the year 2000 or 99? Is this 99? We're coming up to March 2000, or is this
96 when Greenspan said
irrational exuberance? I was going to point that out. Or 95 when Schiller was writing his papers on the overvalued market in the US. I think it's a little bit earlier. I think it potentially has further to go.
What's interesting, we started seeing hyperscalers started cooperating. So the arrangement between AWS and Google, they are going to share some of the sites and then technology. So that is a sign, I think, that they are identifying there's a possible synergy, and potentially we will actually have more rationality in terms of the data center rollout.
It might be the next phase.
It could be,
in what
yeah.
we're going to.
That's
They're
right.
working
Be like
it
the
out more.
airlines in old days. You just roll out as many, as much as your planes as possible, but now you want to share because you want to make money at the end of the day. So you need to generate a return. Maybe that's the beginning of the.
Just to the point about that, the railroads, well, they're a fantastic invention.
I didn't know Chris was around then.
Not many railroads made money. It's the same with planes. Fantastic invention,
That's right.
fantastic. But how many airlines make money? Unless they're propped up by government in some
Qantas.
way.
Yeah.
Well, they're propped up and it becomes a monopoly.
These days
or
Qantas does.
oligopoly.
They never used to. Yeah. Okay, so let's get off a boring subject like IA, get onto equity markets. We've had a pretty good run if you have a look at globally over the last 2025. Nasdaq's up about 20%, even though it had Liberation Day sell-off. The small caps in Australia had a moment in the sun this year, up 18%. Even the European markets have done pretty well. The FTSE's up 17%. The poor old Aussie market, the All Ords at the bottom of the rung, about a 5% return, but still positive. I suppose what we want to talk about now is what could derail it, because we've been going pretty well since maybe the back end of 22, start of 23. We're 3 or 4 years into it, and it's been one-way traffic pretty well. Jim Bay, what can derail this ride in market?
You like to ask negative questions. I think the market is okay, but the risks are, what can derail is this inflation component. I think, the market's fundamental, US rate cuts next year, or this time and next year, and we've got more to come. But Australia, at least we yet to really expect a rate rise. So, environment's pretty good, corporate's good. Like you said, every underlying fundamental is strong. But what really will derail is the inflation pickup. Now, it is Australia, our inflation is already not falling as fast, and it's a little bit concerning. In the US,
to turn up
that's right. And then in the US, I think is where there's a bit of uncertainty there, even though it's falling quite quickly. That's why the rate cut expected. But we haven't had, retailers only just started putting through price increases because of the tariff, right? So some of the retailer facing lower end consumer, they try to put up price increase through. They all had a big profit downgrades there in the US. So now we will start in the next quarter. I think by December quarter, you'll see more of an impact. So question is, will it stick? And if it does stick, that probably means the inflation will probably look a little worse than expected. So that is one tail risk where I think, if the inflation suddenly turned higher, or with the world that structurally the inflation will be higher, that means the money will be more expensive. That's not great for equity market, particularly there in the US. You've got all these AIs and everything. You need money. You need cheap money and easy flow capital. So this may well become more difficult. And also at the same time, with all the changes in tariff and things, just means everything will become more expensive over the long term.
Chris, bringing you here, you've talked about money printing and debasing of currencies, and I think the US in particular is quantitative tightening is coming to an end as we speak. It's about now. And we've got an administration that would probably like quantitative easing to get the yield curve down. Do you see that? You've always said that that's an issue. Do you see that as the main risk as we go forward?
Yeah, I guess if we work back from, say, you've got US midterms in November next year, and for the Trump administration to get what they want in those midterms, they need a strong economy. In an economy as financialised as the US, that to us means strong equity markets. Then you've got a new Fed chair in the seat by May at the latest of next year, who's going to be a Trump sycophant, you would expect, and Hassett is the front runner currently for that.
I don't think this goes to the White House, this show, so you can say whatever you want.
Well, yeah, they'll be aligned with Trump, but for that new Fed chair to come in and pump liquidity, we think for him to get, well, potentially her, but it looks like it'll be him, to get permission off the public to pump liquidity and pump asset prices, it would be more convenient if there was an event leading up to that. If markets are at all-time highs, you get a new Fed chair in who puts his foot on the liquidity gas and the billionaires triple their wealth in 12 months again. That's the sort of environment where you can potentially get the pitchforks sharpened. So we think there are a few signs of liquidity stress now. Perhaps bank reserves aren't where they need to be in the US. We're seeing Japanese yields on their JGBs rip to ripped to highs not seen in a very long time, and you're seeing sort of the standard repo facility being called on from banks in the US, which is a sign of liquidity stress. So near term, we're cautious, but ultimately we think equities are a public utility in the US. They provide so much of the capital gains tax receipts that the government relies on and stock-based compensation that if there is a near-term event, it will be very short-lived. If we think back to the global financial crisis, you had 18 months of a really problematic market for investors. If you think back to COVID, you had 8 weeks. And if you think back to Liberation Day, it felt like we had about 8 days of pain. So those times where the centralised institutions are willing to put up with pain are getting shorter and shorter. We're not ruling out a near-term event like that. But ultimately, we think the answer is more liquidity and higher asset prices, not necessarily because they want to, but with government debt as high as it is in the US, there's really no other choice left.
Yeah, Shane, so that's an interesting point Chris makes. Government debts, and it's not just the US, it's in Europe, it's in Japan, the big economies of the world, is very, very high, historical levels. Can that come unstuck? Because Chris has just painted a case where we probably can't let it come unstuck. And if it does, is that something that could derail equities?
Well, it could if it comes unstuck, but trying to predict when it's going to come unstuck is a really hard thing. To be honest with you, I think that the biggest, putting aside risk about an AI bubble, valuations, geopolitics, the biggest risk would be, you can see a bit of this in Australia with the interest rate fears and talk of higher rates. If that became a global concern, so you've got Canada and Europe down around 2%, you've got the US at 3.5 to 4 or something, that they're sort of on the brink of cutting again as we speak. But if you get the impression that they've all finished cutting rates and the next move will be up and it won't be next year, it'll be soon, then that could derail things, because to some degree, and 24 and 25, maybe even parts of 23, relied on optimism about central banks cutting rates and then the reality of central banks cutting rates. But if it suddenly turns murkier because of inflation fears, then I think you'd have a problem.
Yeah, so you're in that conundrum of we can't cut rates because of inflation and the numbers being printed, which Australia's found out, and the US with the higher tariffs. So that's the worst case scenario.
That's the worst case scenario. I mean, I do worry about the US. I mean, the first time I came across this Kevin Hassett guy, and the book's still on my shelf, is Dow 36,000 in, was it 1999, I think.
He picked the top.
He picked the top, and there was Dow 100,000, which is also next to it on my shelf. And I thought, that's an interesting theory that he had, that the risk premium on equities to bonds should be zero because bonds are actually more volatile on a longer term cyclical basis than equities are. And therefore, why do we have to have a positive risk premium for shares? Interesting argument, but it was fallacious. Now, we eventually get to Dow 36,000, but it was a couple of decades. Yeah. A couple of decades later. In the meantime, we went Kabutsky. And I think there could be a bit of flawed logic. You put someone like that in charge of the Fed, then that does make me worry a little bit. That Powell wasn't an expert economist, but at least he took good advice, and he turned out
and got better as he went along.
He got better as he went along. And I do worry with these guys coming in thinking, we can just run lower interest rates, and Trump has improved things dramatically such that the real rate should actually be lower. That all strikes me as nonsensical sort of stuff. And having politicians or people aligned to politicians controlling monetary policy is just a recipe for disaster. I just had 3 weeks in a country that has inflation around 32%. One Australian dollar buys 27 of theirs, and you've got to go around a pile like this, of this stuff, and what do you do with it? Put it in your suitcase. It's all difficult. We don't want that in Australia, but we certainly don't want that in the US.
You must have been spending too much if you got inflation that high.
Well, the thing is, everything looks, there's other funny things that go on. It plays tricks with your head when it says it's going to cost $27 for something, 27 lira for something, when you expect to be only $1, and your meals cost hundreds of lira or so. You hold back a little bit in spending, so it also depresses spending, but it also distorts decision. If you're someone with high inflation, if you've got to keep changing your restaurant menu every couple of weeks, it's just a huge cost involved in doing all that sort of stuff.
You're changing all the time. But it's a great conundrum where we've got Chris saying there's a lot of political pressure going to the midterms next year in the US.
That's huge pressure.
And you're saying that could be a big risk for markets. So It'll be interesting to see who wins the battle, the politics or the economics.
Well, history tells us that the second year in the presidential cycle, so next year is year 2, has the lowest average return. And historically, if you go back to 1950, the average drawdown in US shares in a midterm election year is 17%, top to bottom. Right. 2022 was an example of that, 2018 was an example of that. So it has tended to be a rougher year. And all the gains are in the final quarter out of interest. So in that sense, it can feel tough in the start, and then finally you get things come through in the end. But there's also some redemption in that Trump is now under massive pressure to change course and be more consumer friendly. And I think he's already seen that. He's cut some tariffs and talking about a $2,000 tariff rebate, which would be bonkers anyway, because give away 80% of their tariff revenue, which would blow the US budget deficit out. But he's going down that path. He realises that he has to get more consumer friendly, which could probably be more market friendly.
Well, Shane, I think you got us to question 4, which is our outlook for 2026. Jimbo, I'll start with you. How do you feel about markets and what kind of return change? Just told us it's typically a bad year in a 4 years.
It's below average.
On average, yeah.
Oh, it's on an average.
Below average.
But below average. Yeah.
How are you feeling about the year ahead? What kind of returns can our listeners think they're going to get over the next 12 months?
Look, I actually think it's still okay. It's still pretty good. It probably will be more or less like this year. But look, I think if you look at here in Australia, we're talking Australia, the expected corporate growth is between 8 to 10%. Sort of growth is still pretty good. And you've got decent dividend coming through, and they'll be supported by a lot of resources, commodity businesses. And I think, even though without the rate increase, it will be a very different story towards the latter part of the year. Our economy is tickling along okay.
So flat rates is not too bad. Is that
yeah,
what you're saying?
it's not exactly. It's not too bad. And if you look at majority of our economy, majority of our sectors, a lot of them are not that expensive. There are expensive parts of the market which at the moment is being crucified, right? It's been sold off. It's been all that. But look, coming to next year, I think there's opportunities in almost all buckets of the space. But more rate sensitive will be a little bit tougher. Your property trust has done so well that there's just going to be a bit of lag on that front. I think the market looks good. I think in terms of the US market, which is going to be the lead for our market, but probably have a little bit higher volatility, is that I do think that this time might be different. So with the US, with the second, the midterm, is that there is a lot of regulation, deregulation coming through, whether it's the financial sector, their banks and others, that might release a lot of capital.
Fiscal stimulus.
That's right, fiscal stimulus, and the Bitcoin deregulation coming through. I think the financial sector part is actually important because with the deregulation, most of them is not going to, in terms of reduce the capital requirement, I think most of those banks, the investment banks and others, they are not going to just go out and buy back their shares, a bit like what Australian companies do. They are going out to do the M&A, the deals and everything else. I recently went and visited a lot of those investment banks in the US. They're talking about advising, $1 trillion worth of assets out there, not just data center, but other things, right? So it is because, there's all these capital release coming through and they want to grow because, organic growth is a little bit tougher, but they want to grow. And regulatory front, the government, the administration is very pro the financial sector to making, to make acquisition and like. What that means is that will support, M&A will always support the interest and the sentiment of the market, and then also the valuation of the market as well.
They work together, don't they?
Exactly. Exactly. And great thing is, equity listed market is still cheaper than the private market. So there's still plenty. There's plenty of money needs to be deployed into the listed market. So, so I think all of that.
So a 9 or 10% gain, that kind of average gain, is that acceptable?
I think it's about 9 or 10%. Yeah. So potentially we'll go a little bit higher with a few other sectors potentially doing a bit better. I think our banks will hold steady. Our resources will do a lot better. Even our growth companies might potentially healthcare, hopefully having a better year. So all of that together, I think it's average return, but still getting you to that sort of almost double-digit return. So that's not too bad.
I'll bring in Chris here. Chris, you've outlined the political setup in the US and what they'll probably try and do. Do you think that carries the day for a market like Australia, which might be hamstrung by higher interest rates?
Yeah, look, I think that the broad-based small cap rally we've enjoyed this year, I think that's going to struggle to occur in a higher rate environment. Australians just have so much debt through our housing market being as expensive as it is. And those small and micro cap stocks do rely on retail flows along with institutional flows to get liquidity. And I think that struggles in a higher rate environment. I think large caps, they really rely on super fund flows, which are just much more predictable than the smalls. So it doesn't impact them so much. I guess for our market, one area we are bullish in is commodities. We think, critical minerals is obviously in the headlines as a major issue, but we think, I mentioned earlier about fewer countries wanting to store their surplus reserves in US treasuries. One area we think they are going to be more comfortable storing their excess reserves is not just in gold, but other commodities more broadly. You used to store your surplus reserves in US dollar treasuries because commodities were priced in USD, and if the currency moved away from you, you could still purchase commodities. We think we may well be entering an era where that intermediary step goes out the window and more countries just choose to store part of their surplus wealth in commodities directly without that intermediate step of US treasuries. And I also think that, the Trump administration has been quite explicit about what their focus areas are. And while critical minerals are in the headlines today, tomorrow we think it'll be the electrical grid, or we think it'll be shipbuilding, or it may be uranium. And there's a lot of sectors there that you can play through Australian listed equities that stand to benefit from what the US administration has said.
So we've got to pick through it, but it's there.
Yeah, but I do think that broad-based small cap rally, I think that does rely on lower rates, and the inflation print, like you and June Bay and Shane have pointed out, looks problematic for continued rate cuts next year.
Shane, that brings you in. You've written during the week, this week, that we're coming up to a crucial point for the RBA in terms of the inflation data, and they'll act, I gather, off the quarterly data, which we'll get early next year, and it's going to decide where they go, whether they keep flat or they've got to go higher, which a few months ago would have shocked everyone. But it's there. So can you give us a feel for what your best guess is? Because we're arriving at that time pretty quickly.
We are. My best guess is that the Reserve Bank will leave rates on hold. I know recently the inflation data has surprised on the upside, but it was particularly that number for the October, the new monthly CPI, which was the one that's tipped the Reserve Bank from talking one more rate cut back in November to now, none or hikes. But whereas that number has got dubious reliability, it's a new monthly CPI. We don't know the spread across each month. We don't know what it tells you about each quarter. And likewise, if I look at business surveys, National Australia Bank does a monthly business survey, it actually shows final price pressures actually being down and a downtrend in cost pressures. Not to say they're higher than they were pre-COVID, but they're down quite nicely. If I look at consumer spending, it's up, but there's no evidence there that it's off to the races yet. And if you start telling people there's going to be rate hikes, I reckon their sentiment about things will start to change. And maybe we're seeing that in the auction clearance rates, which are down dramatically.
They've dropped off quick, haven't they?
They've dropped, Sydney was running around 73%, 73, 74 back in August. It's now, the most recent numbers on the weekend, 69% on the numbers I saw. If you adjust that for the final number, probably 68. So that's a 15, 16 point turnaround. You do get seasonal weakness through this time of year, which is usually about 6-7 points. So we've seen a lot more than seasonal weakness. And that, I think, is an early indicator that consumers are a bit worried. If home buyers are a bit worried about rate hikes, then consumers with a mortgage are going to be a bit worried about rate hikes as well.
So hold for that period? But what about over the course of the whole year? A bit more confident?
I think they hold early in the year. The inflation numbers come down and then we manage to stay on hold through the year.
Right.
That benign-ish inflation numbers.
That's good for equities.
It should be. Yeah, I think the environment, well, it's not as good as it was a few months ago when we were talking about 2 or 3 cuts, but the big one to me is that we've come through 3 years in a row of falling, or financial years in a row of falling earnings. If you look at the most recent reporting season, which was a while back now, back in August, you had more companies saying they're raising dividends on a year ago or raising earnings on a year ago, up on a year ago. So momentum to me, I think is starting to turn up. And so the consensus, which I think is 7-8% or something, earnings growth probably looks about right. And so you've got that coming through, and I think that will keep the Aussie equity market going higher. Now, you got to allow, we're not going to get double-digit returns every year in global shares. They're going to come down, I think, to the high single digits, and similar story for Australia. So I'm reasonably upbeat on the market, but you just got to allow. There's going to be volatility.
It would be nice to get a bit of productivity growth in Australia. That would help.
Yeah, we have seen it in the
up a
last four quarters. It's up 0.8%, but it's got to continue. And the things we need to do, we're not just doing enough of. There's too much regulation. It takes forever to build a home these days, or a block of flats, or anything. So we're stuck. You know, when you talk about abundance, that book had pointed out the problem. We're stuck. You can't do all this stuff. So you've got to get rid of the regulation, or is it? You've got to reduce the size of the public sector. Like, the public sector does a lot of key things, but it's at record highs as a share of the economy. It has to be wound back to make room for the private sector. If you do that, you free up capacity.
Well, my old economic class is called crowding out, I think.
But it is crowded. That's what happened here. It's crowded out, and the initial outcome of that is higher inflation than it should have been, and higher interest rates than they should be. So you get the public sector out of the way, wind it back a little bit. If you're going to spend more on things like aged care, healthcare, NDIS, defence, whatever, you've got to find other areas to cut back on. But we haven't been doing that.
I'm going to take all those comments as mildly bullish. We'll get a positive return out of 2026, which is great. And with that, I'll bring it to an end. I'll say thanks, Chris, Jim, Bay and Shane, for coming in for our 50th show.
Matthew.
I think it worked all right. I think we pulled it off. It's normally one-on-one, and we've got a panel here talking about today's burning issues, so it's worked well. So thanks very much. And for all the listeners and viewers on this occasion, we'll be back in the new year in February, back to the normal format. This was a special occasion, as I said, and I'd like to wish everyone a good break over the period, a good year next year, and also thank the guys at Livewire, James and Izzy, who put the show together every month, do a fabulous job. So all the best, and see you soon.